this video, I'm going to share with you practical steps to manage the flow of money in your business. It's a neat trick, but a powerful one that is going to change your luck with money. Don't believe me? Keep watching. Hello and welcome to season 2 on the channel, the one where you start building a fundamentally stronger business.
I suggest you subscribe, or this puppy gets it.
When I was first in the position of managing funds in a business that I was controlling, I made all the mistakes and then some that every business manager has done one time or another. Maybe you can recognize some of these. First, there was the classic blinkers approach, where I would say yes to new expenses if I saw the money sitting in my account. I would pay no regard to cash flows and budgets. You know the one. Then there was the keeping up with the Joneses. I want to say keeping up with the Kardashians, but I don't think you'd get it. Basically, this is when I would decide that we needed a new piece of machinery or a new piece of tech because it was what other businesses in the industry were doing. Ooh, then there's the luck by chance, when I would keep my fingers and toes crossed that I would have enough money to pay the tax bill whenever that letter came. It was always a 50-50 chance. Then there was Messy Maisie. All the money, whether it was final payments or booking deposits, would go into the same bank account. This was especially problematic since the deposits in the main business account would always end up getting used in my day-to-day cash flow. God forbid a customer ever wanted a refund. Then there was the robbing Peter to pay Paul technique. You know the one where you pay suppliers based on the money available. If there isn't enough money in your account, you do a quick hustle and make another sale to cover the bills that are past due. And finally, you have the big banger, praying mantis, when I would have to say a little prayer every time I had to log in to look at my bank balance. You know, that little bit of divine intervention with that last minute prayer. Theoretically, I'm sure we can all easily describe why this was an unhealthy state of play. But the fact of the matter is, it doesn't change the fact that business owners like you and me keep falling into this rut. It has taken me years, and I mean years, to find another way. The good news is, I reckon I found it. And today I want to share it with you. Now, nothing I explain in this video is going to be revolutionary or particularly novel, but the power it packs is tremendous. So much so that I truly believe this will change the money destiny of your business. Big promises, I know. Let's see if I can deliver. Did you know that according to data collected by T-Sheets, only 9% of new entrepreneurs in 2021 have a bachelor's degree in business? 32% of small business owners have only taken a couple of business classes before they start out, while most 46% don't have any form of business education. What has this got to do with money, I hear you ask? Well, quite a lot actually. The majority of us have no training to understand that the goal of a healthy business is not just to make sale after sale. A truly healthy business is one that manages the money flow in and out of the business and ends the day with a sizable profit to show for all its efforts. It sounds obvious, but think about it. How much of your day is dedicated to making a sale versus turning a profit? When I finally had enough of the constant strain of money mismanagement, I started my hunt to figure out how could I change my business money destiny. I knocked on the obvious doors of learning P&Ls, balance sheets, and cash flows, and whilst they were all fascinating, I found them to be too reactive and kind of like after the fact, like you've spent the money or you've not made the sale and that's when they tell you in the report. They just didn't seem to help a business leader like me take charge and learn how to manage my money in a more healthy way on a daily basis. After lamenting the fact that I never went to business school, I started thinking about my time working as a lawyer, which is what I did before I chose the path of entrepreneurship. It's at that moment I had an epiphany. Controversial opinion. 85% of business cash management issues happen because you're treating the money that comes into your business from sales as all yours the moment it hits your account.
In English, please.
Basically, you keep running out of money in your business because you think it's all yours. I'm here to tell you, it's not. When I was working as a lawyer way back when, I remember being surprised by the fact that every law firm was required to have a client account in the bank. All monies paid into this account were handed over on trust that the law firm controlling the account would dutifully divide and send the monies from this account to its rightful destinations. It was absolutely imperative that whilst in the client account, these funds were not to be treated as belonging to the firm. You could say the account was like a bus station. Different payments would arrive into the station, and the law firm would have to manage the traffic to send out the payments to the right destination and on time. If there was a bill due to the actual law firm, a deduction was made from the client account before the funds were sent, and the bill payment would be transferred to the firm expense account. Now, bear in mind, I was a young 20-something and my commercial awareness was limited to my overdrawn graduate bank account and perhaps occasionally reconciling business checkbooks that I would have to do for my parents' business. So this client account system felt odd to me. As my training continued and I understood the delicacies of managing trust and professionalism, this client account system felt pretty powerful. It gave everyone a moment to do the necessary calculations and traffic direct, so everyone was paid calmly and on time. Obviously, I then went into business and promptly forgot about all of this. That is until I was on this adventure to figure out this money gig. Anyway, this gave me an idea to start looking into other professional industries and their practices to see what I could learn. I found my next nugget in the world of private equity. In the private equity industry, there's a widely accepted money management technique called a distribution waterfall. This technique makes it possible to set up cascading tiers of payments when they want to deliver returns to different types and sizes of investors to the equity fund. So the biggest fish get paid first, and then you've got the little guy and the guy after that. It's all in a waterfall movement. Okay, so now we have two ideas that we know work in two different industries. On the one hand, we have a ring-fenced account systems like the client account, and on the other hand, we have the distribution waterfall. This gave birth to the income to profit money flow protocol. Traditionally, small businesses tend to have one, maybe two bank accounts that they use to manage their money. Money comes in and out of one pot, with the occasional bits being put into a savings account. Or rather, let's be honest, the saving account sits there without much happening there at all, because there's always something else or someone else to pay instead. But we keep the savings account there because maybe, just maybe one day, we'll make enough in sales to put aside something in our pretty little savings account. Well, the income to profit money flow protocol changes this. Actually, rather than just explaining it, why don't I just show it to you? All incoming money from customers comes into a client account. This is the start of the waterfall. Tier 1 of the waterfall is where you remove without question segments of the money that is frankly not yours to use. Sales tax, or the VAT account, which is a straight up 20% waterfall allocation, at least for us guys in the UK. If it is different for you, allocate accordingly, and if such a tax doesn't apply to your industry, you don't need this bank account. Then we have the deposit account. If your business takes deposits from customers for something you deliver in the future, say if you're a construction company or an events company, for example, the money should not enter your cash flow until you start purchasing for the event or for that project. Next, you have the externals accounts. This is where you put the exact amount of the third-party cost, e.g. your sales commission, or if you've taken money on behalf of another business, which you are just going to pass on. And finally, in tier 1, you have the cost of goods sold account, or the COGS account, where I tend to put a percentage of the income. This is something you need to test for your business, but let's say it's around 30%. It's from this account that I pay everything that I have to pay for because I made a sale. For example, if I was a food business, the food produce or the service staff would be paid from here. There is a reality where if any of these are not applicable, you are fine not to have any of these accounts and to go straight to tier 2 division. The tier 2 is where it starts getting interesting. Anything that remains in the client account after the tier 1 waterfall payments then gets transferred to an internal income account. This is now your new 100%, and this is in fact the money that is now in your control, and so it's from here that the second waterfall begins. First, I have a profit account. To this, I let waterfall approximately 10% from the funds in my internal income account. I know it doesn't feel like much, but trust me, this will compound. Of course, you're welcome to test the figures and adjust your percentages, but I found that 10 to 12% generally work well. We then have the director pay account. Now, before you fight me on why this is here and not in the expenses like the other wages that are coming up, I will say this once. No you, no business. This is like the gas mask situation in an aircraft emergency situation. Put your mask on first and then help others. I did this the other way around for so long and it just never pays. I want to bang the table, but I don't want to ruin the mic. You will lose your confidence, your self-esteem gets shot, and you start losing hope when you come home after those 12, 14, 16-hour days because you just can't afford to live comfortably. Don't be that guy. There's no reward for martyrdom here. For this, I tend to waterfall into the account circa 30%. You can test what works for you considering your personal income goals. We then have the tax account, for which I waterfall into the account 15%. Although our corporation taxes are higher, I actually find that accounting for expense deductions, 15% about covers what I need, and I am actually often left with a surplus. Finally, the 45% or so that's left in your internal income account is waterfalled into the expense account. This is where you pay your wages, bills, and other business running expenses from. Even though it may be scary for you to see your income divided in this way, the power of this money management model is how a little bit done consistently every 2 weeks is far more powerful than a quarterly or annual review. I run this protocol twice a month on set days, and the goal is to keep the client account at zero. I move money from my deposit account into my internal income account once the business begins working on those customer projects. Remember, this is only relevant for those of you working with an installment-based payment structure. Any money that's in excess from the sales tax or the tax account, once returns have been filed and paid for, gets transferred into the profit account too. Then quarterly, I divide money sitting in my profit account. 50% is reinvested in the business and 50% gets paid out as a dividend. The cardinal rule in all of this is the fact that whatever you do, you need to stay within your means when it comes to your expenses. You are strictly not permitted to dip into your tax, profit, or director pay accounts. By only having a limited fund for your expenses, we are trying to prevent unnecessary spending and expanding of your business expenditure. All of this is in fact a very simplistic explanation of the income to profit money flow protocol. It has taken me quite a while to figure out all the nuances in the system. Things like how to transition to a money management system like this slowly so it doesn't disrupt your day-to-day business, how to handle debt, how to make and manage 2 weekly internal and external payment runs, how to decide the waterfall percentage figures, and most importantly, how to plug this into the traditional financial accounting model that we need for our accountants and the taxman. Obviously, since this is quite technical stuff, videos like this aren't really the right place for it. So I have put together a comprehensive course where you can do an unapologetic deep dive with me. This is linked below if you're interested. And if the course isn't quite right for you yet, I would suggest you have a read of this book, Profit First, which breaks down a similar model where the author does a great job in making the model come to life. Something that has always struck me about the income to profit money flow protocol is how the little deposits into the different bank accounts grow into something quite impressive. It's definitely something to do with the consistency of it all. In this video about compounding, I explain the phenomena and I suggest you check this one out next. It's a great watch, if I say so myself. Until the next one, you've got this.